In this episode, we're going to talk about how to buy things with the infinite banking concept. But first, take a look at who's back.
We are back from Florida, and although temperatures weren't quite as warm as what we had hoped for, they are warmer than central Indiana, so that was nice.
Here in central Indiana today, it's -2 and feels a little bit colder than that out in the wind. But you know, for those of you in Minnesota, Montana, the Dakotas, you guys are tough. I don't know how you deal with that weather.
There may be no good segue from cold temperatures to how to buy things with the infinite banking concept, so let's make the jump. What is something that comes to mind that you have used the infinite banking concept to buy over the years?
Actually, John, I'm thinking there may not be a good segue as to how to use the infinite banking concept with cold temperatures, but I remember talking to someone over the phone. His name was John also, and he was from Indiana, and he was talking about how cold it was. He's living in Arizona now, but he made the comment, you know, when you have money, you can make it comfortable. And that's true. You know, we have heat. We can go get warm clothes. And yes, when we step outside, it's still cold. But when I turn those heated seats on in my car, it just makes it a whole lot better. So when you have money, yes, you can make yourself more comfortable in those cold weather temperatures. So maybe that is a good segue.
And I'm thinking of Ian, who lives in the cold Midwest, who never could fill up his propane tank to heat throughout the winter. And so he was having these fuel charges and taxes for the truck coming out to every couple of weeks. But when he started doing the infinite banking concept, he was able to pay cash by borrowing from his policy to fill his tank up for the whole year. Saved him a whole lot of money over the years by being able to do that.
Well, it sounds like we did have a great segue from cold temperatures to how to buy things with the infinite banking concept.
I think in relation to your question, though, one of the very first things we bought once we started the infinite banking concept, John, and you probably remember this, is a piano that was electronic that you could plug a headset into. Because you children were playing on a regular piano, a Baldwin piano, and it was driving the whole house nuts as all 8 of you began to practice piano for the day. You know, one person practicing piano for hours, one thing. 8 people practicing piano for 8 hours a day is another.
Well, it wasn't 8 of them at that time. We had 8, but that 8 was a baby, and that means nap time is precious, and you don't want people playing the piano during nap time.
Well, you had a full piano because you wanted us to have the feel of a piano instead of a cheap electronic keyboard. So by using the infinite banking concept to purchase an electronic piano that was piano quality still, yet it still felt like you were playing the piano. So you had that feel. And it did. It helped us to be able to practice more. I remember I would get up early in the mornings to practice. I wouldn't have been able to practice at that time with a regular piano in the house.
Well, I would wake up in the morning and I'd hear this thump, 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 and I'd think, what is that? Oh, John's playing the piano. And instead of a bunch of music, you know, you just wouldn't have done that because it would have waken up the whole house.
Because we had the cash value in our life insurance policy, we were able to do a cash deal for that piano, that electronic piano. We were able to get and negotiate a trade-in for our Baldwin, and we were able then to negotiate a cash price. Because when you take a loan from your policy, you've got the cash to go make a cash purchase. So you're not giving up the ability to barter and make a deal for cash, because cash is always cheaper than credit.
But when you say we paid cash, we didn't walk into the store with, you know, a wad in our pocket. Instead, you know, we looked, we shopped, the whole family went, you know, the baby's in the car seat, and we all went in there. We looked at the pianos. We heard them play. We talked about all the different features. You ended up asking one of your patients, who was a concert pianist in Europe for years, to come in and play the keyboards. So we knew that we would be getting, you know, a quality keyboard. You want him to help you with that research. But we went in, we decided on what we'd like, and then we just took out a credit card Because we knew we could get that policy loan in our account so that we could pay off that credit card. Because when we use credit cards, we never just, brought them out to use without having the money to back up in our accounts.
You used it more like a debit card.
Exactly. And debit cards weren't really a big thing when we were growing up or when we were starting out. So always we use that credit card like a debit card where the money has to be in the account before you pull that out, or in our case, a policy loan that could be there so that when that payment was due, we could pay it off.
Some people seem to have a hard time thinking that way. If they have the credit, then they use it, regardless of if the money is there in the bank to help cover that. Some people, they start out with the right intention to use a credit card like a debit card where they only spend what they have in the bank to be able to pay it off. But then those good intentions fall somewhere along the wayside when an emergency pops up and the credit card ends up carrying over and expanding. So how do you stay just using it in a disciplined manner?
I think maybe a story about the past might be appropriate here. Credit cards used to be very rarely used in our society. I remember growing up, my dad had one credit card, and it was a gas card for Shell Oil Company. And the only place that credit card could be used was at a Shell gas station or to buy Shell products. We would go to the gas station and he would fill up with that credit card, and they would come with a little box and they would take an imprint of his card and give him a receipt, and that's the way it worked.
It was almost like a rewards card for using it at that.
He got a discount on Shell products by using the Shell credit card.
Yeah, and what customer loyalty there, because he had a Shell card, so that's where he got his gas.
Exactly. Then in 1987, I was out of school and I was taking a relicense your credit seminar. And I remember not being able to find any place to buy food close at hand except a Burger King. I was starving. I went in there and I was shocked that you could pay with a debit or credit card.
Because that was a new thing.
Because that was the first thing. Everyone always wrote a check or paid cash when they went out to eat or to buy groceries. It just was not a common thing to use a credit card. Now, Amex and the Diners Club card were around at that time, and people used those to go out to eat at fine restaurants or to go to hotels. But it wasn't something that the common people really used. We didn't use credit cards. In fact, we would put our driver's license on the top of our checks so that when we went to the grocery store to buy groceries, we didn't have to pull out our driver's license each time.
Yeah, because they would just write it down, so we would just get it imprinted on there and save a step.
And so the fact that credit has become so easily available in our society is why we see, over $1.1 trillion of credit card debt in this country.
So it must be the way that people are thinking about it. You started out with the debit card mindset, basically, because you started out with the check mindset. And you just moved that into the new tools that were being used. People that are starting with the credit card mindset, because that's just what's available today, maybe they need to do a little bit of extra thinking in order to use it with the right strategy.
So the infinite banking concept, Nelson Nash, the founder of it, used to say everyone needs to be in two businesses. The business that they do, whether it's a job or they're an entrepreneur or on their own business, the business that makes your money, and the banking business. And the banking business is, you have to think different if you're going to be in the banking business. You have to think more like what Americans always used to think about, that there's a cost to money. And either you're going to pay that cost to somebody else when you use theirs, like with a credit card, or you need to see how you can pay that back to yourself and have that cost come back to you. That's what bankers do. And bankers have opposite bookkeeping from everyone else. A liability to us is an asset to a banker. An asset to us is a liability to a banker.
That's a way that you have to think different as a banker than you would kind of just like you do to use a credit card wisely. You have to think a little bit different. It's a different type of thinking when you're in the banking business.
The credit cards love it when you put stuff on their card, because now they're going to earn interest off of you, or they hope to earn interest off of you. Now, if you're thinking like a banker, you're not going to let them collect that interest. You're going to keep that interest for yourself. And so you're going to pay that credit card off at the end of the month after the 28 days or whatever their cycle is to give you free use of that money. It's the people that hold over month to month a balance on their credit cards that get into trouble. And I was just reading the other day, according to lendingtree.com, 48% of people do not pay their balance off at the end of the month.
Wow.
Well, we did pay the balance off on the keyboard. We went ahead, purchased it with the credit card. When the credit card payment was due, we paid money that we had borrowed from our policy. We set up an amortization schedule, and every month we made loan repayments to ourselves. And that was over 18 years ago that we made that purchase. And since then, we have purchased an additional keyboard, or replaced that keyboard, if you will. But that's provided 18 years of people being able to play the piano anytime they want. Now, maybe not people aren't napping, but other things happening in the household, they're still able to play the keyboard, and people have pursued singing and songwriting.
Now we're talking about the wealth that came from that. Mm-hmm. Okay, not only did we get our money back that we would have paid someone else for that keyboard because we were doing the, we now have the wealth of all of our children that sing and are invited to sing at other places. Would that have happened had we not introduced them to music early in life?
What's something else that we've used the infinite banking concept to finance?
In the Infinite Banking book, it talks about financing vehicles. And so when we would tell people we financed a keyboard, they said, well, have you financed a car yet? And no, we hadn't. That was not our priority. But it did come around. We needed a 15-passenger van to haul us all around, and the groceries and the luggage when we'd take a vacation.
Well, and we already had a 15-passenger van, but it was time to replace it.
It was time to replace it. And so we went to Ford Motor Company in town, and there was a fellow there that was a high school friend of mine, and we negotiated a trade and a cash deal again. I think we paid $33,000 for that van, and we did it with cash because we were able to borrow it from our policies, and we negotiated that price with David, who was my friend, and it was a great van.
So what surprised me, after purchasing that van, well, a little background on the McPhee family. One day, my father-in-law comes over, and he's starting to tell Tom about something, and he reaches into a pocket, and he pulls out a business card, and he's looking at it to tell Tom about it. And Tom comes around to help look at the card with him, and he quickly pulls it away. Suddenly it was very private, and McPhee's were private about everything, finances, everything. And we've just purchased this van, and now we're going to these events. We're gathering people together to talk about the infinite banking concept. He starts telling people about what we had paid for the van, and then he starts telling them about what we're going to pay ourselves back monthly. And I was just, I felt like, taking that card back a little bit. But he was so excited about what we had purchased, how we were financing it, and showing people that when we got to the end of our payment schedule, we were still going to have the van, plus we were going to have all the money that we had paid for it, plus interest, back in our control. And I remember, that felt odd that he would be telling people that, but I remember their eyes just opening and their mouths opening, just amazed. And then they would say, well, show me how I can use this. And maybe they were going to buy a vehicle, maybe they weren't, but he could apply it to different things then and show them how they could benefit. And that was a difference, but it was an exciting difference too.
Personal examples make it easy for people to say, well, if this person can do it, I can do it too.
I remember you working examples on taxes and healthcare and just all kinds of things so people could understand, maybe the vehicle wouldn't work, but maybe something else would work for them.
Well, it's been said that the poorer people make money to spend it. Middle-class people make money and try to save some of it. And the wealthy use money to make more money. And a banker and the way that bankers think and work is, how can I spend money so I make more money? And that's the mentality that we have to have if we're going to make the infinite banking concept work for us. If you own your own business, or you're thinking about owning your own business, you will want to listen to the next half of this podcast, because we're going to talk about what businesses use the infinite banking concept for and how it benefits them and their owners.
If you haven't subscribed to the Wealth Talks podcast, you can subscribe for free. Just go to Wealth Talks podcast on YouTube and click subscribe. Not only will you get the weekly episodes, you'll get special clips with valuable nuggets of information you can use to win your financial game. Make sure you subscribe.
Let's talk about the least exciting things to finance and then move on to the more exciting ones.
The least exciting thing for a business owner to finance is probably taxes.
Nobody likes to pay income tax. Nobody really likes to pay property taxes, but those taxes can be financed through the IBC system.
It's a wonderful way to finance taxes.
It is.
Because taxes only come around about once a year. It's usually the schedule they're on.
The way this happens is that instead of paying quarterlies or putting in a sinking fund or putting in an escrow for your taxes, you put it in a policy, a whole life insurance policy that's developing high cash value, so that the cash value is there when your tax bill is due. And now you're able to borrow from your policy and pay the IRS or the county for your taxes or the state income tax. And you're not then losing the growth on the money that you have to pay taxes on. Because when you borrow from a life insurance policy, you're still earning the growth that's guaranteed in that policy plus any dividends on it, even though you've leveraged it to pay your taxes with it. So now you've turned a total expense into something that is generating a little bit of profit.
And the 1 year turnaround time on tax bills tends to be a good schedule, because you want the money in the life insurance policy long enough that the interest on the policy loan isn't going to offset all the guaranteed growth you're getting on the long term for that policy loan. So by paying that loan back through the year, taking the policy loan to pay taxes, you're still getting enough benefit with that schedule to make it worthwhile.
Yes, that's right. Let's say someone's got a $3,000 tax bill for property taxes once a year. They can set up where they borrow that $3,000 from their life insurance if they've got the cash value there. And now they can reset a schedule of repayment that is maybe 50% of what they would have had to put in escrow or in a sinking fund to make sure they build that. So it decreases their required cash flow outflow
on the front end.
And they can stretch the payment out over 2 years.
You could pay it back over 2 years. You could also pay it back over 2 years, and that's what you're talking about here to help ease into this.
Well, John, did you
strategy.
say the same thing? 2 years or 2 years?
I was thinking 1 year. A 1 year schedule. If you pay it back over a 1 year schedule, it's still worthwhile. If you pay it back over a 2 year schedule, like Dad's talking about here, now we're getting an element of cash flow in here. So you don't have to, how did you get the $3,000 there to begin with? Setting a repayment schedule over 2 years can help you ease into that until you're finally paying your taxes, on a yearly basis or every 2 years, where you're making the repayments.
Yeah, it saves 50% of your cash flow in year one of that repayment schedule. By the time year two comes around and you've paid second year taxes by borrowing from your policy, now your payment into the life insurance policy is identical or really close to what you were paying in taxes in the first place, and yet you're still earning compounding growth on all that money instead of it just sitting at the IRS or the county or the state or wherever you paid it to.
Yes.
So I'm thinking an example of paying property taxes. Some of our great clients, they've told this story over and over publicly. So Elena was interested in purchasing a policy, and she did. Her husband wasn't interested in it. But tax time came due, property tax, and he said, where are we going to get this money? And she knew this happened every year. And she said, well, you can borrow it from my policy. And he said, oh, what, really? But this tax bill's, whatever it was. And she said, yes, I have the money for that. Oh, so they did. They borrowed the money and he paid the tax bill. And next year comes around and he says, oh, it's tax time. Where are we going to get this money? And she said, well, you can get it from my policy. Really? And after that second year, now he is a little more interested, and he came to us, and sure enough, he bought policy on grandson, and they're great clients, and they tell the story. It's the money is there, and when you pay it back, it's there again. Taxes may not be real exciting to pay, but you've got to pay them anyway. So it was a great way to do it.
A lot of people find it easier to write a check to their insurance policy, which they control, than to have to put that money out to the IRS or the county every year for property taxes.
And people sometimes get on payment schedules that they owe the IRS and have to, pay back income tax. The IRS will put them on a payment schedule, but that's rigid. So if you can put yourself on your own schedule, then you have control over that. 1 month you might be going on vacation, so maybe you slack off a little bit. And the next month, you have an excess of funds, you can put more towards that and, maybe speed up that schedule or just continue on the schedule at a convenient payment for yourself.
I thought about this when you were talking about the keyboard example before break, but it applies to this tax example as well. You could get on a payment schedule with the IRS, pay the IRS back. You could get on a payment schedule with a credit card when you bought the keyboard if you didn't take a policy loan to pay the keyboard off. You're getting on a payment schedule when you pay back a policy loan. So what's the difference as to what loan it came from? One of the differences is the interest rate. With the policy loan, you tend to have a lower interest rate than you have on a credit card, and maybe even a lower interest rate than you would have on the loan from the IRS to pay the taxes. So one of the ways is that you get control of the payment schedule. You can decide how long you're going to take to pay this back. You can make it comfortable for cash flow. That's one of the things. The other thing is that you still have the guaranteed growth in the policy while you're doing that. Now, in order to get there, you had to make an effort to set money aside. And this is what a lot of businesses will do, or even people in their personal life. If they're living hand to mouth, the first step for them getting away from that is to set up a sinking fund method where they save up to make the purchases. But that's only once removed from hand to mouth. The second step is to make that savings in a place that's giving you long-term growth and control over the savings. Then when you leverage that sinking fund, now you can pay it back on your own terms. You're in control of both sides of the banking equation instead of only one. Now we're twice removed from the hand-to-mouth mentality.
Really what you're talking about, John, is the cost of money. And you want the cost of money always to come back to you if you can help, if you can make that happen. So if we have a sinking fund and we put it at the corner bank down here, or even worse, we put it in our desk drawer or someplace that's not earning any interest, there's a cost to that money just sitting there. The bank isn't going to just let it sit in their vault if you have it at the corner bank. They're going to go put it to work and make money on that money. If you have it in your desk drawer or the freezer or someplace else, it's earning nothing and inflation is destroying it.
Even if you have it in some savings accounts, it's earning hardly nothing.
So now if it's in the corner bank and we take that money out to pay our taxes or to buy something with it, we lose all the growth that the corner bank was going to give us. If we take it out of our vault or our drawer or whatever, now we've lost the money and we have no potential of earning any interest on it if we're just paying a bill with it. But if that money is harbored or stored in a life insurance policy, when we leverage it to pay a bill like our taxes or to buy something or to finance something, we do not lose the growth on that money because the policy doesn't recognize that there's a loan out on it. We can't borrow that money again until we repay it back, but the growth on that money continues to compound for us.
As business owners, there were other things that we needed for our business. And so one of the things that we purchased was billing software. And we could have gone, use the buying on time with the billing software company, but we could purchase that same software at a discounted price if we paid upfront. And so we borrowed from our policy to make that purchase. And then just like we would have had to pay to the billing software company, we just made regular payments back to the policy. Now, as business owners, when we borrow from the insurance company to purchase one of our expenses, we also get to write off the interest that we're charged by the insurance company for that expense. And so that is a way to get money out of our corporation that doesn't pay like the FICA and things like that. We don't have that extra tax on it, and we get to write that off.
One of the reasons that taxes are something that business owners tend to finance is because employees often have taxes just taken out of their paycheck. And so they'll end up getting a refund at the end of the year because they tend to overpay the taxes with what's taken out of their paycheck. Business owners, on the other hand, have a little bit more discretion on how much they're paying in taxes throughout the year. And so maybe it gives them that opportunity to set a little bit more aside. Property taxes, not necessarily. Sometimes they're included in part of somebody's mortgage as part of the escrow. Sometimes they're not. So that's an opportunity that people have to put money aside to help pay the property taxes. Other things that business owners finance could include phone systems, copiers,
remember
advertising.
I'm thinking about when we need a phone system.
Yes.
And so we looked into it and we found out what the cost would be at the leasing. We had the option to lease. And you did the math on the leasing option, and it would be like paying 30% interest because, after a certain period of time, then you're going to own the phones. And we decided we didn't want to pay 30% interest. So we took a loan from the policy and purchased our phone system outright and then just made payments again back to ourselves.
It's real easy to take that schedule that the leasing company gave us for that phone system and to say, instead of writing a check every month to the leasing company, we're just going to write it to the insurance company.
Or maybe we're going to set up a draft so the insurance company can draft whatever amount we've chosen for our loan repayment from our account every month. We don't even, as we do our books, we plan for that draft and it just happens.
Or here's the other thing. If we don't like that schedule and it's too much cash flow going out every month for the phone system, we can stretch that payment out, lower the payment, and end up earning more money or keeping more of our own money by doing that. Because that's what credit cards do. They give you a minimum payment and they say, you can take 30 years to pay this off, and they more than double their interest. And so, again, it's the banking mentality.
And that's where we just put on our banker hat and think like a banker.
Having the infinite banking concept work for you can make things that maybe aren't really affordable cash flow-wise, affordable for you because you can stretch the payments out and make the monthly payment lower and still have the use of that product immediately.
So here's another thing we bought for our business, but we did not buy it through the infinite banking concept, and that was a copier. We needed to purchase a copier to do all our scanning, everything that we needed that for. Copier,
this was more than a
faxer.
copier. Yeah, it was a multi-function machine. It had the scanner, the copier, a fast printer, even a function that helped staple documents or sort them as they came out. We were printing a lot and we needed a bigger machine.
Yeah, it's a huge machine, stands up, and we had the opportunity to purchase that outright. We could have taken a policy loan and done that, but we wanted to have all the service that came with the machine that we were buying on time. We figured that might be a savings to us. And sure enough, we did need service along the way. And so, just because you have the opportunity to finance something doesn't mean you necessarily will finance that thing. So always thinking like a banker. How am I going to make the most money? What is my potential opportunity here?
I was reading through Proverbs the other day and came across this verse in Proverbs 13:11, and I'm going to paraphrase it. It says that money that comes to us quickly soon dissipates, but money that is gained little by little grows. And credit, especially credit cards, can be money that comes to us very quickly, which can get us into trouble even faster. because of the interest rate and the repayment terms. But building up a cash reserve in whole life insurance, little by little, can be something that continues to help your wealth, your money, and your prosperity expand and continue to grow.
Business owners, rejoice. Next week, we're talking about a large company who's using whole life insurance to create a to-die-for, no pun intended, financial arrangement to benefit all the business partners. That's next week, right here on Wealth Talks.